In this tutorial, I'll be showing you about a symbol HUBG, and I'll just copy that. I will paste that and write stock besides, and I can see the name of the stock, and I can see it's 40.3 US dollars per stock. To buy the stock, one stock costs 40.3 US dollar, and the market cap is in billions, so it's a big firm, and the dividend yield is none. So the dividend yield matters because when the firm is able to generate extra money after paying their creditors' loan liabilities, they still have money left. That money they give as dividend to shareholders, which means companies who pay dividend, that means they're able to generate extra money that they can pay off to shareholders. And if the company doesn't pay any dividend, um, that means they might not be financially strong, and it could be, but it could be something else, because there are many firms who are very successful, who are financially very strong, but they still don't pay the dividends. So it's just one factor, and so you need to consider about that. And it's founded in it's not written outside, so I'll just go to Wikipedia and I can see it in the box, and you can see founded 1971, and you can see other information as well. If I just go back and I want to copy this part from Google exactly, and I will just go to, I'll just write reviews, and indeed I will just go to the reviews, and I can see there are 218 reviews, which is quite a lot, and it's 3.3 star, which means it's above average. And you can just read through it as well. And if I just go to reviews and I go to Glassdoor, which is another brilliant website, and I want to see the reviews, so we have 286 reviews, and it's 3.7 stars, which is a lot above average, which means it's doing very good according to the employees. And let's go to Justia Patents and see if it has any patents registered, and I'll just paste it in search. You can ask me as many questions as you want. So I'm just interested in assignee or applicant, but I can't see if it has any patents or not. So you need to go through that. So you need to make sure that besides the assignee, the name of the firm is written. But actually, I can't see it right now. You have to go through the list yourself and see if it has any patents, because the more patents it has, the more competitive edge it has, the more moat it has, the stronger the firm. And make sure it has recent patents as well. And I want to go to Yahoo Finance to see the executives and if they have shown their salaries, because the more transparent the better. So like if you see, both names are same, but I'm just looking at this symbol, so make sure the symbol matches with the name, and go to profile, and then you can see the sector is industrials, industry, shipping, logistics, full-time employees, and you can see that there are 5 executives, but 4 of their salaries have been shown, only 1 is not shown. You need to see why it's not shown, and you need to see like the more information it has, the more transparency. And now I want to go to macro trend, and I'll show you 4 ratios that are very important. I will just paste in the symbol here. I'll just copy that and paste in the symbol and click that and go to price ratios and then price book ratio, and then it's just loading. Sometimes it takes a lot of time. Price book ratio is the real worth of the stock. The stock price is the market price. If the stock price is 2 and price book value is 1, that means you're paying $2 to buy something that is $1 worth, which means you're buying it very expensive. So, if the price book ratio is less than 1, that means that the stock is undervalued, it's at discount, and it's very cheap, and it's the right time to buy. If it's 1, that means that the real worth and the market price is same, that the stock is not expensive. If it's more than 1, that means the stock is expensive. The higher the number goes, the more expensive it gets. And I just want to see here that it's 1.35, and so it's 1.35 times more expensive. If I just have a look in 2008, it was 4.72, nearly 5 times more expensive. So right now it's the cheapest since we have the data since 2006, because it's 1.35 times more expensive. But it was the most expensive in 2007 when it was nearly 5 times more expensive. If you just go up, you can see that people who bought that time, they paid $35 to buy something that was $6 worth or $7 worth. So they paid a lot of money. But right now the stock is at its cheapest, even though it's a little bit more expensive than its real worth, but it's the cheapest from 2006. So let's go to other ratios and go to current ratio. So the current ratio, if it's less than 1, that means the stock is very risky. If it's 1.5 or more than that, that means stock is not risky, it's very good to buy. Right now it's 1.18, it's less than 1.5, so it's risky. Okay, let's look at previous trends. So it's 1.5, and then like it's fluctuating. mm, I would say that it's like fluctuating. So from 2008 December, it became more than 1.5, and then it became down, then up and down. So it's fluctuating. Right now it's not, it's risky. So right now it's risky. It should be 1.5 or more than that. Let's look at debt equity ratio. This ratio should be 0.5 or less than that for it to be safe and not risky. Let's have a look. Right now it's 0.22, it's less than 0.5. Let's look at the back, the consistency. So it has always been below zero point 0.5 since we have the data. So it means it has been consistently been safe, and it's below zero point 0.5. It is very safe stock, which is very good. So let's look at return equity. It should be 8% or more than that for it to be really good. Let's have a look. Okay, so it has been more than 8%, yes. Let's look at the previous trends. So it has always been more than 8%, except in, I would say, 2015 June, but that's just once. And since we have the data since 2005 up till now, it has been above 8%, which is brilliant. Mm, so we have looked at the ratios, and we've seen the everything.